Hello and thanks for watching. This is Dan Perkins for Money in Motion video blog. Thanks for watching. Today I want to talk about the minimum wage. I want to talk about unemployment benefits. I want to talk about Obamacare. And then I want to spend a little time talking about the markets. So we got a lot to cover. Let's get started. First, the president who told the Congress, I have a pen and a phone and I'm going to use it. And if you're not giving me what I want, I'm going to use the executive order to get what I want. And directly to his word, he signed an executive order that says for all government contractors, starting in 2015, after the existing contracts are up for renewal, any organization that wants to do business with the government has to pay the minimum wage of $10.15 an hour, up from $7.75. Now, we know that the president, if he could, and he may try, depending upon the outcome of the election in this fall, would like to have the minimum wage across the board in both public and private sector as soon as possible. And he may yet try. But nobody in the press seems to asking the question, how are we going to pay for it? If the cost to the government for having people get $10.15 an hour, a new minimum wage, the contractors who are provided to the government are either going to have to do one of two things. If they want to maintain their profitability and try and stay in business, they're either going to have to raise the price for which the government pays, or they're going to have to lay off people in order to generate enough cash to be able to pay a 30% increase to the remaining employees. In the case of maintaining and raising the price to the government, that means that you and I pay more. We're going to have to pay more. And you know what? That's exactly what's going to happen in the private sector. In the private sector, restaurant, hotel, movie theater, whatever it is, department store, if they are forced to raise the minimum wage from $7.75 to $10.15 an hour, then they will have to make similar decisions. Can they pass it along to their customers? Probably not. A 30% increase in their labor cost, which is probably one of their largest costs in their business. So what they're going to do in order to comply with the law, my guess is they're going to have to lay people off and hope that they can hold their revenue so that they'll have enough money to pay the remaining employees $10.15 an hour. We're paying again. So in either case, I'm asking the question when the public press is not asking the question. Where does the money come from to pay? From us. It's a tax. It's a form of tax. Whether you call it wealth distribution or redistribution, bottom line, it's a tax. It's taking away my income or return on my investments and your investments to pay a higher cost of labor because the government says so. Now let's talk about unemployment. I told you in a blog on Christmas Day, and I doubt that anybody watched it on Christmas Day, but hopefully some did afterwards. I said in my blog on Christmas Day that I was shocked that the budget resolution, which was designed to get hold of the budget and the first actual budget that the Congress has operated under in many years, had in it a provision to eliminate the continuation of long-term unemployment benefits. That's people paying people for 99 weeks not to work. There wasn't one Democrat during the whole process who stood up, including the president, and said, we can't do this, we have to have continuation of benefits. These people are hurting, we don't want them to starve. Nothing, not a word. The Republicans were duped, as I said in December, because shortly after the president signed the bill, Nancy Pelosi, minority leader in the House, stood up and said to the reporters, it's unconscionable that we didn't continue the long-term unemployment benefits. What really is unconscionable, Congressman Pelosi, is the fact that this government is not providing the incentives to the private sector to hire people. Yes, corporations are sitting on a great deal of cash, but the man sitting in the White House and the unpredictability of his behavior and what he's going to do that will affect the cost of us to do business in the United States is causing them to be cautious and not hiring. If we had a government and a leader, a president, who was encouraging us to hire as many people as we possibly can, putting millions and millions of people back to work, then we won't have to worry about deficits. We won't have to worry about tax revenue. There'll be plenty of money to go around. But the government, run by the Democrats, would rather keep people on the public dole than to putting them to work, paying taxes. And as long as we continue, people will take the money. You see, it's easier to not work and receive the money after you've been out of work about 6 months. Most psychologists will tell you, employment psychologists will tell you, after 6 months, it becomes more and more of a psychological challenge to try and get back into the mainstream of employment. If you've been unemployed for almost 2 years, it is really, really hard to get back into the job market. And so the idea that the government is going to continue to pay you not to work is appealing to a lot of people. I think if we can put people to work, we can eliminate long-term unemployment benefits. And so the Congress, the Democrats in the Congress stood up and said, we have to do something about this. And so they said, well, we'll just fund it for an additional 90 days. Like in 90 days, the president's magic pen will in fact find enough jobs for 4.6 million unemployed, long-term unemployed Americans to go back to work. Not likely. So you can expect in 90 days at the end of the first quarter, if this passes, or whenever it passes, for the Democrats to come back, well, we need to extend it for another 90 days and another 90 days. And we basically have created a built-in incentive for millions and millions of Americans to never try to go back to work again. Obamacare. The president said he's going to postpone some mandates again. It's amazing to me that legislation passed by the Congress, which had specific dates, the President of the United States has decided to ignore. Some provisions he's going to enforce, other he's not. He's told us you can keep it, you keep your plan if you like it, you can keep your doctor if you like it. We know that that was an out and out lie at least 27 times. And so we have a situation where corporate America can't trust the president to figure out where the hell he's going. In fact, the Speaker of the House recently said, as it relates to immigration reform, there's a great reluctance to pass immigration reform because the Congress believes, at least the Republican Congress and perhaps some of the Democrats now, that they can't trust the president to enforce the law. He'll do what he wants to and change the law when he doesn't like what we've passed. So the point is, the president is not being reliable. He's not being directional. And when individuals and corporations don't know where the president's going or where he wants to go, they're reluctant to make any long-term decisions. Finally, we've been talking about, over the last several blogs, 3 key indicators. The price of crude oil, the price of gold, and the price and yield of treasuries. Over the last 3 to 4 months, they've been fairly stable. The price of crude oil has been under $100. Gold has been in the $12 to $12.50 range, and the yield on the 10-year treasuries have been about a 2 3/8 to 2.5. Janet Yellen, the new chairman of the Federal Reserve, testified on Tuesday, and on Wednesday, Thursday, and Friday. She testified on Wednesday. On Wednesday, Thursday, and Friday, the markets changed pretty substantially. We had crude oil over $100. We had gold over $13.10, and we had the yield on the 10-year Treasury at 2.75. Now, right now, it's difficult to tell whether those are short-term blips or fundamental shifts, and we have to keep watching it. But Chairman Yellen said to the Congress that she believes in the tapering, and that unemployment seems to be getting under control, and that the Fed may, not necessarily will, may accelerate their tapering by reducing the amount of purchases they have, and at some point in time may in fact begin selling treasuries in the marketplace. Now, based on her testimony, people are saying that they think that the yield on the 10-year treasury can go from 2 3/4 to 3 1/4, about 50 basis points or 0.5% move. I think they're wrong. I think between now and the end of the year, we could easily see the yield on the 10-year treasury close to 4 and the yield on the 30-year at 5. If you got those kind of rates of return on fixed income government guaranteed, I think the equity markets come under some pressure, some significant pressure. And so I'm going to be watching very carefully the movement of oil. If we continue to go higher, and this is not a blip, and we see several weeks where the price of crude oil continues to rise, gold continues to rise, and yields continue to rise on treasuries, then I think we are in an inflationary situation and the economy might be a little stronger. I believe, though, by the time we get to the fourth quarter, just before the congressional elections, I can see that we would see some contraction in the economy, and we may see a correction in all three of the indicators that we're watching. So it's a lot to digest, and I'm sorry I dumped it all on you at one time, but I've been thinking about it, and I wanted to get it out to you. I hope you like the new camera. I'm still getting used to it. So if you have any questions, please feel free to give me a call or send me an email. And if you have friends or family members who are looking for some advice, please feel free to give them my name and number. Thanks for watching. This is Dan Perkins.